I will say welcome, everybody. Welcome to tonight's session with regards to Show Me the Money. This is a webinar for people who want to learn about different ways to get your real estate investment portfolio funded. I will say that this is not an all-inclusive session with regards to all of the loans that are available out there. If you want to know about more of the loans, there's showmethemoneycourse.com. Showmethemoneycourse.com is where you go when you want to learn, like, hey, I want to do ground up construction and I want to build a 3 unit. How can I do that? Well, you can go right there and it'll say, ground up construction for multifamily, for investment properties, and you're able to go and click on that and listen to videos that are up to 10 minutes long for each kind of product out there. Whether you want to do house hacking, you want to buy short-term rentals, long-term rentals, ground up construction, all sorts of opportunities are there for you with regards to building your portfolio, because everyone's going to build their portfolio different, with different types of assets. So, but today's conversation is really just an overview of some of the most used and most popular loans that are available for you. And during tonight's session, if you have a question, since this is such a small, intimate group, you're able to unmute yourself and just ask the question that you have. So my name is Cheree. I am with Simply Funded, and I specialize in helping investors build their portfolios. So I am a lender for a lot of investors, a lot of self-employed people who want to purchase properties for themselves to live in. And I also am licensed in Maryland, DC, and Virginia. So I'm also able to help people purchase their own homes for them to live in, whether you want a house hack or you're buying a home for you and your family, or you want to build an accessory dwelling unit on your property and get some rental income that way, all sorts of ways. I'm very creative with working with my investor clients. So it looks like Zoom has has changed its look a little bit, but I think I have what we need here. So if you all can just make sure you let me know if you can see the screen. It should say "Show me the money," funding your real estate deals. And this is 11 slides, I think, of a presentation, so it's not very long. But if you don't see it, just let me know. Okay, so there are different loan programs that are available for you as you're thinking about buying your first investment property, buying your next investment property, how your portfolio can be structured, and again, the lending products that are available to you. So tonight, we're going to talk about fix and flips. We're going to talk about how to fix something and rent it out long term, how to buy rental properties, some low down payment options that are available for you, and some gap funding that we have available for our investor clients as well. So the first question that I always like to just have you think about is, what kind of portfolio do you want to buy? Are you looking to have cash flow coming in? Are you looking to build properties that have a lot of appreciation? Are you looking to make cash, have active income? Because that's going to really kind of dictate the kinds of properties you're looking to purchase, and then ultimately the kinds of properties that are going to go into your portfolio long term. There are some people who say, hey, Cheree, I just want, I actually have one client, we want to make $25,000 a month. They've said that to me, husband and wife team. Well, in order to do that, because they're starting from zero right now, they have to start with fix and flips. And then I've encouraged them to think about maybe selling two, keeping one, selling two, keeping one. And actually have a client that I worked with years ago who built a $2 million portfolio by doing that. She would buy properties in Birmingham, Alabama, and she would buy them. She would take 30 days to renovate them. She would put a renter in them, and then she happened to work in the Pentagon. So she would get people from the Pentagon to purchase them as real estate investment properties for cash flow. And she would sell two, keep one, sell two, keep one. And she ended up telling me a few years after that that she built a $2 million portfolio just by following something simple like that. Some of you may say, no, Cheree, I want to hang on to everything I'm getting. I am a collector. So great. What kind of rental properties are you interested in? Are you thinking long-term rentals? You want to do medium-term rentals? You want short-term rentals? You want a mixture of them? You want to do rooming houses, group homes? There's a lot of different ways that you are able to purchase properties and different groups of people that can rent those properties for you where you're able to maximize that income and that cash flow. So, again, really just kind of thinking about how you want to build your portfolio, what your portfolio is going to look like in the next 5 to 10 years. The final thing I will say is this. Sometimes I do have people who will say, every once in a while, Cheree, I don't want these loans on my credit report. Well, in order to do that, you may um, have to pay a slightly higher interest rate. You might pay another $50 to $100 per month for that. But then when you are ready to go and buy your next home, for you and your family to live in, you don't necessarily have all these properties on your credit report. So sometimes people will ask that, and it is something, again, that you want to think about. There are positives and negatives to both. There are certain loans that are not dependent on your personal income. They're dependent on the property's income. And we're going to talk about those tonight. But really, again, just having a vision about what kind of real estate portfolio you want to build. And again, don't forget, if you have questions, you can just unmute yourself and ask away. So the other thing to think about is that every deal needs credit and cash. For some of you, it doesn't have to be your credit. For others of you, it doesn't have to be your cash. There are people who are money partners who, if you bring them a good deal, they will bring the cash. They will bring the credit. They will bring both. I have clients that do that all the time. I have a refinance I'm working on right now. The gentleman owns the property, but he brought in a credit partner to actually be the credit partner in order to refinance the property so that he and his partners are able to buy more properties. So people will do that all the time as well. But just remember that as lenders, we need to pull somebody's credit because each of the loan products, even for private loans, we do at least look at your credit. We don't necessarily care how much you owe Home Depot, Neiman Marcus, anything like that, but we are going to look at your credit score. And unless it's a refinance, you usually have to have some cash that you're bringing to the table. So fix and flip loans. Some of you may want to do active income. You find a property, you want to renovate it, and you want to sell it. One of the big things that I always suggest to people who are new to real estate investing is your first property should not be a property where you have to do a full gut renovation. You are looking for something that requires paint, carpet, appliances, and you're able to put it back on the market for sale in 30 to 45, maybe 60 days maximum. But, as you become more and more experienced, then you may want to get into those properties that require more of a renovation. So these loans are usually 6 to 12 months. They usually require a 660 or higher credit score. You'll pay anywhere from a 15% down payment to a 35% down payment. And the favorite lender that I love to work with, they will charge you 15% to 35% down payment of the purchase price only. And then they'll pay 100% of the construction costs up to $250,000. So you may ask, Cheree, what's the difference between 15% and 35%? It is your credit score, it is the location of the property, and it's your experience. So the more experienced you are, the less down payment you'll have. If the property is in a city or a suburb where there's lots of buyers, the less the down payment will be. However, if you're buying in a remote area, in a rural area, you're going to pay more of a down payment because the lender is thinking, hey, there are fewer people who are going to want to purchase this property. Therefore, we want you to have more money down. So that's the difference between 15 to 35% down payment. These loans can close anywhere from 10 days to 30 days. Higher If it needs to close in 10 days, you're going to pay higher interest rates. However, if you can close in 30 days, then you can pay lower interest rates. You may ask right now, well, what are the interest rates? I've seen for my fix and flips right now, anywhere from 9% to 12%, sometimes 13%, but mostly 9 to 12%, you are pretty safe with regards to your estimates as you are putting in offers on properties. And more experience equals better terms. This is for the fix and flip loans. You may want to fix something, buy it, fix it, and then rent it long term, whether it's a long-term rental, short-term rental, medium-term rental. There are two options that you have for this. The first is the home style renovation loan. It is a loan where you go to the closing table, you close the loan, and then once you have renovated the property, you do not need to go back to the closing table. So that's why it's called a one-time close loan. So once you close the loan, you are going to renovate the property. And then once you're done renovating the property, it automatically converts into a 30-year fixed term, fixed loan, fixed interest rate loan, right? So the way that the home style renovation loan works is it is a conventional loan product, which means that they are going to look at your income from your W-2, if you have a business from your business, in order to determine if you can get this loan. But I do have a couple of investors that prefer the home style renovation loan because they don't have to close and then close sometime in the future once the renovations are done. So with this specific loan, the way that it works is that you'll find a property, you will have your contractor put together a renovation budget. The contractor will then turn the renovation budget over to us, as well as your offer would be accepted. And then we send it to the lender for review. You will also need to have a HUD consultant go to the property. And what they're going to do is they're going to bring your contractor's construction scope of services or your contractor budget. And they're going to look at that budget and they're going to say, did the contractor capture everything that needs to be fixed in this property? And the answer is going to be yes or no. So let's say yes, they did. Great. Then your appraiser is going to go to the property with the construction budget, and the appraiser is going to say, Once all of these repairs are done, that's on this construction budget, what is the renovation or the value of this property going to be? The after renovation value. And that is the appraisal value that they're going to give to us and to the lender. And then from there, you're going to pay it's usually 15% down payment for these home style renovation loans. So it's an option for you with regards to buying something, fixing it up, renovating it, and then renting it long term. You can also, if for whatever reason your own personal finances prevent you from doing option one, you can get the hard money loan or the 12-month loan. You can fix the property up, and then we're able to refinance you into a 30-year loan. So, option two, you are going to have two sets of closing costs. But one of the things that I do as your lender is I make sure you know not only what the loan terms are for the 12-month loan, but what we can roughly expect the refinancing to look like. So I'll have people come to me sometime and say, "Hey, Cheree, I I want to pull cash out during the refinance period." Great. I'm going to do some calculations and let you know, okay, you will be able to pull cash out or you won't be able to pull cash out. Or if you're putting an offer in on this property, the way that you're going to get cash out is if you are able to get an offer of X number of dollars accepted. Okay. Uh, so these are two different options with regards to buying a property, fixing it up, and renting it long term. And I've had clients do both of these. Let's say that the property is already fixed and you just want to purchase it in order to um, rent it out. Long-term rental, short-term rental, property doesn't matter. This is called a DSCR loan. DSCR stands for debt service coverage ratio. And basically, all that means is, does the rental income pay for the mortgage? If the rental income pays for the mortgage and you have a 660 or higher credit score, you're approved. It doesn't matter if you're underemployed, if you have a lower income, if you owe lots of money, you have lots of debt, for example, on your credit report or anything like that, the lender will look at your credit score. However, all that's required for approval is, does the rental income pay for the mortgage? Now, with regards to the mortgage itself, the mortgage is not just principal and interest. So if you were to put something into a calculator, you may say, Cheree, but the principal and interest, the rent will pay for that. No, there are a couple of additional things that's added to the mortgage. So the mortgage is principal, interest, taxes, insurance, and any HOA or condo fees. And I recently had a client who, because the condo fees or the HOA fees were over $300, we had, to be creative with regards to helping her get over the threshold of being approved by the lender. So, when you're looking at properties, be careful of the HOA fees because sometimes that can mess with the deal, or the condo fees because it's oftentimes not the principal and interest or the insurance. Sometimes it's the taxes, and sometimes it's the HOA fees that are pretty high. And anytime you have a situation where you're like, "Hey, Cheree, uh, you know, can you do these calculations for me really quickly? I'm thinking of putting an offer in on this property." You can, reach out to me, let me know, and I will work with you, send you an answer back really quickly with regards to that. So, Jules is asking, how much down payment does this one require? So, this DSCR loan is anywhere from 15% down to 35% down as well. And the difference between 15 and 35%. So there, number one, there's only one lender that I have that does 15% down. Oh, that's not true. I have two lenders that do 15% down for this kind of loan, but it's based on where the property is located. So it is it in a city or a suburb where there's lots of people who want to rent that property? Um, and how good the what's called the ratio is. So in other words, if we'll use simple numbers, if the rental income is $1,000 a month and the mortgage is going to be $750 a month, then the banks are really going to love that. So you're going to get the ability to get a lower down payment in that scenario. Number three, you get lower down payments if you have great credit and or if you have great experience as well. But I will say this, if the property is in a remote or a rural area, it'll hardly never be 15%. So that's like the number one thing is where the property is located. But great question. Thanks, Jules, for asking that. Um, so again, these DSCR loans are great for people who are doing medium-term rentals, long-term rentals, and short-term rentals. With short-term rentals, they're usually with a short-term rental, you're expected to make more money, have more revenues than a long-term rental. There are a couple of lenders that I work with that will use the short-term rental expected income from AirDNA. If you're familiar with AirDNA, they will use that income in order to calculate whether or not you could get approved for the mortgage. So when you're talking to me, you can say, hey, Cheree, we're going to use this property as a short-term rental, because then what I'll do is I will get that expected revenue for that property, and I'll do my calculations really quickly and let you know what the loan is going to look like before you put your offer in, or as we're going through and about to submit the loan to the lender. Okay, so you can definitely let me know that. Uh, yeah, low down payment. Okay, so some of you may say, well, Cheree, I don't have 15%, 20%, 30% to put down. What can I do? Uh, the way that you're going to be able to build your portfolio is by buying primary residences every 1 to 2 years. And there are people that do this. They do it through house hacking, or they'll buy the primary residence for their family. Their family will live in there 1 to 2 years, and then they'll move to the next property and they will rent out the previous property that they owned. So you are able to, with the primary residence, it's anywhere from 3% to 5% down. Some of you are veterans, so you're able to get in with 0% down. Just be aware with your veteran status that you have a certain amount of eligibility that you have. So you're not necessarily able to build a large portfolio with just VA loans. But you are able to, just as a regular person, get either conventional loans or FHA loans. These can be 1 to 4 unit properties. So I have a client in Atlanta who converted her basement into a second unit. So, and she's renting out that second unit, and then she wants to move someplace else and have those 2 units as rental properties that can cash flow for her. So with any kind of primary residence, you are able to live in one of the units and rent out the other units. Okay. FHA loans are 580 plus FICO score. Conventional loans are 640 plus. There are some people who can get approved with as low as a 500 FICO score. That does take a lot more work, but it can be done with regards to approvals. The caveat is that if you are buying a 1 or 2 unit property, you do have to be able to afford the entire mortgage on your own. Uh, so even though you're saying, okay, Cheree, I'm gonna house hack, I'm going to have other people live in the house with me, that rental income that you're expecting will not count if you're buying a 1 to 2 unit property. If you buy a 3 or 4 unit property, we're able to count a portion of all of the units that you expect to rent out. We're able to count a portion of that revenue as part of your income. So um, you can also use the home style renovation loan that I talked about earlier to turn a 1 unit into a 2 unit. So that home style renovation loan is super cool because you're able to uh, have a contractor give you a budget with regards to tearing down walls, adding bedrooms. I have a client who turned a 3 bedroom, 2 bath into a 6 bedroom, 4 bath in Washington, D.C. You're able again to turn a 1 unit into a 2 unit. One thing I will suggest is make sure you're getting your permits for anything that you are building, because I have had clients who didn't get permits for what they were building. They changed a 1 unit into a 2 unit, or they added an additional dwelling unit, or things like that. And when they went to sell the house or refinance it, they couldn't do so because they did not legally build out those uh, additions and things like that. So, but there's a lot of different ways that you're able to have a low down payment as well and basically build and grow a portfolio. The final thing is gap funding. Gap funding is only available for investor loans, and you kind of need to tell me you're using gap funding before we submit your loan to the lender. However, I have a client who used credit cards. She had some credit cards. She ended up buying a property in Baltimore, and this specific lender didn't care where her down payment money was coming from, and she was able to use gap funding in order to purchase one of her rental properties. Also, I have another lender who, if you have $25,000 or more in your 401k, if your 401k is not at an employer that you're currently working for, they are able to basically give you a loan against that 401k, and you still have your 401k money like growing for you. You don't have to take it out and have tax penalties. So if you want to know about either of those options, email me and I will forward you the link so that way you're able to learn more with regards to those options. So with that, you could call or text me. You can let me know if you have more questions. So Jules is asking, a PMI is only for conventional loans. So PMI is for conventional loans or FHA loans. And with FHA loans, you will always have PMI. Um, However, for conventional loans, once you have 20% equity in your house, then they will get rid of PMI. So basically, that 20% can come from you paying down the loan, or it could come from appreciation of the house. Either way, you're able to you know, no longer have to pay PMI? That's a great question. Other questions, you can unmute yourself or you can type it in the chat.
Cheree, can you hear me?
Yes, I can.
So with the what was that first loan you talked about? The fix and flip. With
Yes.
that, and
Uh-huh.
is that one also like so say the first plan is to fix and flip, but if
Uh-huh.
I'm able to sell, we can change it to a conventional, right? Is that also requiring two closings?
Yes, it does.
Okay.
Yes. Yes, because the fix and flip loan is only for 12 months. So if you, for whatever reason, you can't sell the house and you decide, hey, I want to convert this into a 30-year loan, then yes, it's gonna require a second closing.
Okay.
Mhm.
Thank you.
You're welcome. You're welcome. And I have a client doing that right now as well. She bought a house, she was going to flip it, and she ended up getting a really good tenant for a really high rental rate, and she's keeping it for the time being. So, yeah, it happens. Anybody else? Questions?
Yeah, one more, sorry.
That's okay.
So can you do the hard money fix and flip loan to the DSCR loan, or is that like,
Yes.
okay,
Yep. You certain actually that's a better way to do it. I don't suggest people get conventional loans unless they have some reason for it.
what,
Um,
why is that?
Well, because it's just easier to say, hey, does the rental income pay for the mortgage? And we're not worried about your debt to income ratio and the other requirements that you have with regards to getting a conventional loan. And the interest rates are, I won't say they're practically the same, but they're maybe an eighth higher for you to
Okay,
get the easier loan than the conventional loan. So I don't recommend it to my clients unless they have some specific reason why they want a conventional loan.
okay.
Yeah.
Another question.
Sure.
Sorry, if anybody
That's
else has
okay.
a question, I can shut up. Um, so you had mentioned, oh, I don't want all of these loans on my credit. Does
Mhm.
that change at all if you buy a property within like an LLC?
Yeah, so usually you will have to be a guarantor on the loan. So even if you buy the property in an LLC,
Mhm.
it still may end up on your credit report
Okay,
because you're the guarantor on the loan.
got it.
Hmm.
Thank you.
Hmm. Sure. Anybody else? The one thing I will say about having the rental properties on your credit report is it comes up when you are trying to buy a new home for yourself, you and your family to live in. So what happens is I have clients who get rental income and they don't put it on their taxes. And then we can't count that rental income that they're receiving from that rental property, you know, we can't count it to offset the debt on their um, on their credit report. And because of that, their debt to income ratio gets kind of messed up. So, the other thing is if you buy a rental property this year and then you want to buy a new home for yourself next year, usually the bank wants to see 2 years of rental income for that property on your taxes. So that's where we would just, need to kind of coordinate if you are like, hey, Cheree, next year we're probably going to um, buy another home for ourselves to live in. Well, then we just need to know that in advance. So that way we're able to make sure that you buying the rental property this year is not going to negatively impact you buying a property for you and your family next year. So again, that's one of the benefits of working with me is I kind of think a couple of steps in advance for you just in case. Anybody else have questions? Okay, well, I recognize all of you, so that's a great thing. You all know how to reach out to me. Oh, I see something in the chat. Oh, thanks, Jules. Thank you. You know how to reach out to me anytime. Let me know if there is anything I can do to assist you, if you need pre-approval letters, anything like that. You want me to talk with your real estate agents that you're working with. We're just here to be a resource and an asset to you as you are growing your portfolios. So, thanks so much for being here and dealing with my Zoom issues this evening as well. So, all right, ladies. Thanks, Kim. All right. See you all in the next couple of weeks. Take
Thank
care,
you.
ladies. Bye bye.
All right, bye bye.